Hey, everybody, welcome back to another episode. I'm your host, Brandon Cobb, co founder of HBG Capital. And I've got a special guest on the show today, Mr. Rob Beardsley. He's the founder of Lonestar Capital. Dude, he's done over $750 million in acquisitions in multifamily real estate. He sold over 30,000 copies of his two best selling books, Commercial Real Estate, and he speaks at real estate conferences nationwide. I've seen him speak at Raise Fest and the Best Ever before, and he's the host of the Lone Star Capital podcast. Welcome to the show. What's going on, Rob?
I'm doing great. It's great to be here.
Good, man. One of the things we've ran into each other in some circles, and one of the things that I've really admired about you is I think that you're younger than me. I'm 34. I don't know exactly how old you are, but I look at what your assets under management is, and I look at mine, and I'm like, holy cow, how the heck did this young guy do this? I mean, it's really inspirational for somebody like me. Um, can you tell us a little bit about that? Like how you must have gotten started at a young age or something like that.
Yeah. So we're close in age. I'm 28, and I started the company with my co-founder when I was 21 back in 2018. And I mean, there's maybe from the outside looking in, the story sounds spectacular, which, it is. It's a great story, and we're very fortunate. But in reality, and you know this as many people do, the nitty-gritty nuts and bolts daily grind is exactly what it is. It's like a daily grind. And then the magic sauce is people and partnerships and leveraging people outside yourself. If you're trying to accomplish any big dream vision, you can't do it yourself. And so having a business partner who had more experience, more age, more contacts, hiring the best people and growing the company with kind of a team dynamic in mind and being willing to partner with outside companies as well has allowed a 21-year-old kid like me start a company, have no business running, and fast forward, now we have a sizable portfolio and a big company that's effectively outgrown just me running around doing everything.
Yeah, I mean, $750 million in acquisitions is absolutely bonkers. I can't wrap my mind around that, especially before the age of 30. I mean, I think you are the only person I know who is under 30 years old and has that kind of experience. So that is very impressive. Did you get started at 21 years old? What did the business look like? What did the Rob Beardsley look like at 21?
Yeah, I think the funny thing is obviously I've grown a lot and I've gained a lot of experience over the last 7 years. But I think the core me was still inside there. I was just younger and I looked younger. And so I maybe had a little less confidence as well. And so those were really the biggest challenges. I think that knowledge isn't overrated, but it's just easy to get, right? There's so much knowledge. You do this podcast, we do a podcast, there's books, there's meetups, there's conferences. And especially in real estate, we're also giving in our knowledge. I feel like it's a very sharing community. So the knowledge part, I think you can get into this business and learn in 6 to 12 months enough to get started. Obviously, what I love about this business is that every day you can come to work and still learn more, right? And so I'm
Yeah.
just getting started. But I when I have young people like myself come to me and they say, "Hey, I'm getting started. I want to take the next step, or I want to leave my job and start my own thing," and they're asking me questions like, what should I read or what should I learn, or they tell me that they're gonna kind of wait 2 more years while they gain more experience. And like when I hear that, I mean, just honestly, I just think, you know what, it's probably not for you because you're you don't have the entrepreneurial mindset to take the plunge. And maybe they
Mhm.
do, they just need a nudge, but that's not the gap that you need. And so at 21 years old, really the gap that I needed was self-confidence, which I had some, but I gained more over time by just living and breathing the business. So that was attending weekly meetups, going to conferences like the Best Ever conference that you mentioned, and just talking to lenders, brokers, investors, and just getting into the game. And so that's what my 21-year-old experience looked like, was just basically being a good balance of confident, like, hey, I belong, but also humility in saying, yeah, I'm young. I'm not gonna hide it too much. I did try to hide it a little bit, but I'm
Yeah.
gonna be humble and basically come to you and say, hey, how do I do this better? Go to a lender and say, hey, here's my loan proposal. How can my numbers look cleaner that makes you happier, and so on and so forth.
Yeah. It's funny. I remember when I started when I was 27 and I consider that young. So like, you're 28, so you're a year after when I first started. And I just remember feeling like a fraud, interviewing people for the first time and being like, oh my God, they're gonna find out I have no clue what I'm doing. And I literally am just figuring this out. And I remember the first interview, I think I was moving into my apartment and I did it on a beanbag and I was so concerned about my background and them seeing me on a beanbag that I set it up in a way where it looked like I was like standing up and positioned it where they couldn't see like the messy apartment. It was just the back wall. I mean, it was just full of thoughts on what other people thought of me. And it's just kind of funny how you go through and you hire enough people and you go through the whips that, eventually that kind of wears off. I want to talk about, how you got started. Asking somebody just directly, well, how'd you build a $750 million portfolio was a lot like asking somebody, well, how do you raise kids? And you got kind of an answer, but you can't really get the whole thing out there. So let's see if we can't break that up because that is super impressive to do as a 28-year-old. How did you first get started? You were going to a lot of meetups, you were reading a lot of books. You mentioned that analysis paralysis kind of keeps a lot of people stuck. Oh, just one more book or maybe a few more years after I have some experience. Not many people take the plunge at 21. What was it that made you take the plunge? Did you come right out of college just running and gunning, or did you have any kind of previous work experience?
When I was in college, I was studying computer science, and kind of in my spare time, I started just researching real estate. And it wasn't a huge leap for me because my family has a background in residential brokerage. So my parents bought and sold luxury homes for their clients, but they never truly once did a real estate investment. So that was really the big difference and kind of the aha moment for me, if you will, because I saw my parents scramble running around doing, commission deals, but I thought, wow, that doesn't look glamorous. That doesn't look even smart, just frankly speaking. It makes more sense to me to build a long-term portfolio, a legacy, a business, not just build a business that's a glorified job, but a real business that is bigger than yourself. And so I kind of had that vision stuck in my head and took that and just started studying everything about multifamily because obviously multifamily is just a pretty straightforward extension from single family. Everyone can understand apartments, right? We all have lived in one
Yeah.
and so on and so forth. So for me, it was the easy thing to grasp onto, and I'm very passionate about building businesses, teams, kind of organization and things like that. So it really kind of hooked me on this idea that I could actually build something right off the bat rather than go to work and kind of build a career and whatnot. And my calculus actually was in my second year of school. I thought, okay, this is a very interesting opportunity. I can get a lot of experience in accounting, in running a business, in real estate itself, in finance, in operations. And if I drop out of school and give this a try and it doesn't work, I can just come right back to school and pick up right where I left off. And I had the privilege and luxury to do that. And so to me, it felt like a very low risk decision. The
Mhm.
only real risk was just time, if you want to say time, and social reputational risk, which I didn't care much about. So I felt that it was a good risk, and I made it, and that's what allowed me to get started so young.
So you did whatever good entrepreneurs. You looked at the risk to reward ratio. You're like, okay, look, the worst case is I'll just go back and get a job. And that's kind of funny because I looked at it the same way when I got fired though. I don't consider myself a natural entrepreneur. I was forced into it. And I remember thinking, well, I don't have a job. I guess I can give this a shot for 6 months. That's not the end of the world. Burn through 30 grand. Okay, I got that. And all right, worst case, I'll just hop back in. So you saw the upside potential was way more than what the downside potential was, and you went for it. So walk us through what did that first deal look like for you? Did you immediately jump into multifamily?
Yes, yes. My business partner and I, we felt that it was smart to immediately jump into the types of assets that we'd want to be acquiring and operating rather than buying a single family house, then a duplex, and then a fourplex, and slowly scaling up from there. We kind of had psyched ourselves up to saying, you know what, if you're going to do it, let's go big. Let's, overcome the limiting beliefs. Let's just make it happen. And so that's exactly what we did. And it's a lot easier said than done because it's one thing to build up the courage to do it. It's a whole other thing to put a $15 million property under contract and take all that risk that we did, which we were essentially risking money that we didn't have, going to in order to raise money that we never had raised before, right? So it was just a lot of assumptions that we made that we'd be able to pull it off, and we were partially true. I mean, in the end, it worked out, but there was so many bumps in the road and so many mistakes made. But like I said, we were able to be actually in the game and live to make those mistakes rather than just kind of writing things out on a spreadsheet and mapping things out and wondering how it would go down. I mean, we were living and breathing what it was like to be on an investor call every single day and ask for money and kind of overcome those hurdles and answer those tough questions and build relationships along the way. And then yeah, and then once actually we're operating the deal, then of course we made every mistake in the book when it comes to operations, and that's how we learned how to operate as well.
Yeah, because I know you guys got y'all's own property management company, and I believe you guys are vertically integrated or mostly vertically integrated. So all right, so overcame the limiting beliefs, went through it, did your first deal. At what point did things start to, pick up? You're 21, you start your business. When did you realize that you had a scalable business model? And like, I don't know, usually there's a light bulb moment in every entrepreneur's mind where it goes off. It's, for us, it was like when we had made like three times as much money on a particular type of deal than we had in the past. We're like, why are we doing this other thing? Like, oh my gosh, this is it, and this is scalable. What was that moment for you, if you can remember?
So I think it's funny in our business, and I'm sure you can understand this. In our business, I think many people are originally attracted to the size and scale of the business because you think, wow, I could buy a $10 million deal and collect a $200,000 acquisition fee. This is incredible, right? So a lot of people, and this is unfortunate because at the kind of height of the market, a lot of people were getting into the business of multifamily syndication, not just investing their money, but actually starting businesses for this very reason because they thought, oh, wow, this is so easy. Everyone's doing it. I can buy a $10 million deal and charge a 2% acquisition fee, and that's 200 grand. And with one deal, I've replaced my income. So a lot of smart, high earning people made that calculus and made that decision. And we did the same thing back in 2018, and we were partially true. I mean, this is partially correct. However, the thing is yes, when you do your first deal and you finally earn that acquisition fee, that's really exciting, especially if you're actually able to get a 2% acquisition fee. We earned far less than that because doing our first deal, we had to bring in investors on much more favorable terms, and we had to share a lot more of the pie in order to get the deal done. So in the end, I wasn't looking at a $200,000 check. I was looking at a $40,000 check, but I was
Yeah.
thrilled because I was gaining experience and I was 21 years old. And then as your company grows, you want to buy more deals, and then your portfolio starts getting bigger. And then you realize, wow, this is actually an incredibly people intensive business. You've got acquisitions, you've got finance, you've got capital raising, you've got asset management, property management, construction management. So before you know it, you really have a tremendous need for hiring, and all that all those juicy acquisition fees that you thought would be scaling up your business are actually just going to just making payroll. So I feel like there's a actually quite a long, so there's like a nice intro period where you have a small company and it's just you or you and a couple partners and you're closing deals and you don't really have any expenses. You don't have an office, you don't have employees. And so when you close a deal, you get this big acquisition fee and life is good. Then you get into that awkward growth stage, like when you're growing out your hair and you get a, fancy expensive office like this, you start hiring people, asset managers, acquisition people, investor relations people to kind of help service your investors and so on. And then before you know it, your profit margin goes from 80% to 20%. And you're not making, I mean, you're hopefully making some money, but it's
Yeah.
not the juicy machinations you had in your head before. So, and we're still living that awkward growth stage, I'd say. I mean, it really does take quite a long time to achieve the scale needed in multifamily management for it to really make a lot of sense. So that is, I mean, it's a long way to answer your scaling question, but I feel
Yeah.
like we're kind of still right in the middle of it.
There's two things I want to talk about: the people, one, and then the second is talking about what you just said about the tough growth phase. I've got a business mentor who he spent over 30 years going into businesses and making them better. And he would, he started his career going in, like a failing company would, a bank would call him because they had invested in this company. It was failing. They were going to lose their investment. He would come in, run it, turn it around. They'd sell it and he'd get a piece and make a bunch of money. And he did this with just tons of companies. And he says, Brandon, it's all about the people. It's all about the people. And it's so funny because we develop land and sell to national home builders, and I look at D.R. Horton and Lennar and Smith and Douglas. They're all the same company. They build houses, but the people that run that business model dictate their success. And that's when it kind of hit me. I was like, oh my gosh, it really is all about the people. What have you learned with hiring and managing people today that you wish you could go back and tell 21-year-old Rob?
Yeah, I have learned a ton. And I think that hiring is one of the most important skills as a business owner, as a manager of people. So you need to be able to hire great people, you need to be able to retain great people, and you need to be able to promote them as well. And like you said, that's just the key to everything. And I guess going back telling 21-year-old Rob, I would tell him that my standards need to be twice as high as I thought they should be for
What does it?
what.
What does that mean?
So what I thought was a good employee, I should have doubled that standard. Meaning I shouldn't have just been happy like, oh, we hired Fred and Fred's doing a good job and seems everything seems okay. You have to be really exacting. You have to really, really be critical. And the reason why this sounds obvious, but it's so hard for people to do is because we're talking about people here and not numbers or products, right? And so it's hard to walk over to Fred and tell Fred, you're just not doing a good job, and here's why, and here's what you need to do in order for you to be doing a good job. And also, then Fred might start doing a good job, and then a month later he slips and he's back to his old ways. And so it's a never-ending game with, managing people, with finding the right people. The way someone interviews is not perhaps someone the way they work. So I just think that your bar has to be so high, and my gut has always been right. And it's not necessarily because, oh, I have such a good instinct. It's just because everyone's got this gut feeling. Like, when you see someone and you're like, Fred's just not cutting it, but I'm going to give him another 6 months. And then you gave him that 6 months, and then you look back at that gut feeling 6 months ago and you thought, you know what? I should have just acted on that gut feeling 6 months earlier. So it's super cliche, but hire slow, fire fast. Unfortunately, when you're growing company, you are often hiring under the tyranny of the urgent. And what are you going to
Yep.
do? You're going to make mistakes. The faster your timeline for hiring, you're going to make mistakes. You're going to say, let's just get that person because we just need to fill a body. So you're going to hire fast and you're going to fire slow because you're going to hang on because, oh, well, if we fire this person, then we're going to have to go back and hire again. And what if we don't get it right again? Super, super tough.
Yeah, no, it is. It really is, especially when you make the wrong hire and then you kind of got them plugged in and you figure out, oh my gosh, they're not working out. But now they're doing all the things that you need them to do. And you're like, oh, I gotta hire somebody else and replace them and plug them in. Yeah. What you talked about the growing pains. And it's funny, I was having a conversation with a buddy who's also in multifamily, who's we had like an hour and a half conversation. We're catching up, and he's like, Brandon, he's like, man, like, I really want to scale this thing and I see how to do it, but we're just going to have to operate unprofitably for, I mean, several years, before I get there. And that's funny that you're now bringing up, you didn't say those exact words, but it sounded like, something similar where it's like, hey, in order to grow, we're going to have to, owners are going to have to take less of a paycheck to reinvest back in the business to get the baby to grow. What does that look like with multifamily exactly? Like, try to paint that picture for me and put it in context. I'd like to understand it. I'm kind of thinking about it like software. So, software, you need a team to be able to get the software built and running. And in order to grow that team, you need more money. Well, in order to get more money, you need more users, right? And that's why some of these software programs like I love Loom, they can charge $10 a month, or Netflix, right? $10 a month. It's like, how the heck, can they afford to do that? Well, they got a billion people watching their stuff. They got over the scale problem. What does this look like with multifamily, and what is the way through it and solution look like?
Yeah. So, I mean, since you brought up software, I'll just say that software has the best unit economics because the marginal cost of software is zero, right? Basically. So it's super expensive to have the developers to kind of build up the software. But then once you have it, you just sell a license, you sell a seat, and you keep going and going and going, and you scale that, and then you're super profitable. Multifamily is, I wish it were as good. It's not quite as good as that, but it's similar, except for the fact that with every unit you add, with every property you add, you're invariably going to need to add more people, right? You're going to need to add more asset managers. You're going to need to add more regional managers. And as with scale, you're also going to get more vertically bigger with more kind of middle management and more stuff. And so this is especially true and much more difficult, kind of how your buddy's saying this, maybe like a drop in profitability if you're vertically integrated. Because if you take on the responsibility of managing the day-to-day operations, yes, you get to collect the 3% acquisition or a 3% property management fee, which is off of revenue. So, you take let's say, for example, $100 million portfolio, super simple math. Let's say that $100 million portfolio throws off 10 million of revenue. And then if you get a 3% property management fee on that, that's $300,000. So now you have to take that 300 grand and basically pay for accounting, HR, regional manager,
Yep.
to manage the staffing, training, banking, accounting process, and construction as well, for that portfolio of 100 properties or 100 units. Oh, I'm sorry, 100 million. Don't want to make it more confusing than it already is. So you can see, I mean, if you kind of crunch the numbers, like that's not a lot of money to work with to manage that 100 million. But if you
No.
go to a billion, now you're talking about $3 million. And now you can run an accounting department, you can run an HR department, you can have a training department and a hiring department, a procurement department. So, these management companies can be as big and robust or as small and lean as you want them to be. And so, we only recently started up our HR department. We didn't have one before, right? But now we do. So we're kind of trying to thoughtfully manage the scale and how big our portfolio is and how much revenue we're pulling in, and then to how robust and to the scale of our operation.
Oh, interesting. And what is what's that saturation point? Like what is that assets, or maybe not assets under management, but maybe that revenue number need to get at where it's like, hey, you've broken through that minimum threshold that you need to build the team that you want, and it's just all gravy on top from there.
I think about a billion.
Billion assets under management, not revenue.
Yeah, that's right. Billion assets under management.
Okay, so after $1 billion, it's spitting off enough where you can build the A team to go out and really execute on things. Okay, see that's really interesting because you're right. You broke it down perfectly. You said, "Hey, look, 100 million. That means you're making maybe about $300,000 per year. You can't build a team off of $300,000 a year.
You
It's
can
just
run,
not possible."
yeah, you can keep things afloat, but you're not gonna, invest in scaling up and growth and whatnot.
Yeah, because after you've built that A team, $3 million a year, now they can take on a lot more. You can add a lot more to you've got the infrastructure built to really just pour on acquisitions and really add fuel to the fire. That's fascinating. Well, one of the things that I feel like you're really good at, you've written the book on underwriting, and you tend to attract these, family office, institutional type investors. What is it about Lonestar that is able to differentiate? How have you guys been able to differentiate in the space to attract capital sources?
Yeah, so I think we've really set out to do the basics really well. And when it comes to investor relations, the basics is communication, transparency. So that encompasses when you have a deal, you've got your ducks in a row. You have a good data room, you've got your underwriting there, you've got a good pitch deck that has all the information at their fingertips. It's transparent, you're not hiding the ball, and things like that. So that's the ABCs, that's super basic. And then when you're actually in the deal, it's about monthly communications, monthly distributions, quarterly reporting. and being on top of things in that regard as well. And I think you can win investors over with just the basics like that. And from then on, we've just always tried to do things a little, maybe a little bit smarter, a little bit better than the status quo. And,
Yeah.
something that we might talk about a little bit later, some of the unique strategies that we've employed also to find value in the market when it's been tough to do so.
Yeah. It's funny that you mentioned that. You didn't tell me anything that sounded amazing. I didn't hear you dropping any secrets. I got to take a peek behind, somebody, I think it was $100 million portfolio. We've developed maybe about 18, 22 million per year in land stuff. And, he'd raised a lot more money and had done a lot better. And I got to take a peek behind things. And I'm like, okay, what's the secret here? All right, what's he doing that we're not doing? And I, for example, looked at, his LinkedIn because we raise money off LinkedIn and he raises money off LinkedIn. And I looked at how many direct messages he was sending a day to people that had interacted with his post and how much we were. We were doing like 4 or 5 messages a day. He was doing 50. I looked at his investor onboarding program with like the amazing gift basket that they get, the multiple touches, the handwritten thank you cards, the quick win as soon as they got the money. Like I was blown away at how much better he was than me. There was no word to describe it. There was nothing that he was doing differently. It all boiled down to blocking and tackling, and he was doing it just way more volume than I was and doing a much better job of it. It was very humbling to see that. And I got to be like, wow, okay, got it. Like we just need to stick to the fundamentals and execute. And you kind of summed that up perfectly right there.
Yeah, I've had a very similar experience hearing somebody say that on a stage talking about their process and it's so robust. And we call the investor right after they fund, and then the gift basket and the thank you note and all this stuff. And it's, oh, wow, this is intimidating. This is, this is way better than us. But over time, I think it's overwhelming when you hear it all together and you have none of it, or you're only doing
Yeah.
some of it. But the good news is that person that you heard that from or who I heard it from and now us, none of us developed this overnight. It took years of stacking little processes on top of each other until you kind of come to this amalgamation of everything just sounding so amazing and just boom, boom, boom. But
Yeah.
yeah, it's very similar to our content process as well. A lot of people are really impressed with our content marketing and the videos we put out and the podcasts we do and things like and the books and it's like, wow, you guys are just everywhere. You're on LinkedIn, you're on YouTube, you've got books published. And it's true, and we've worked hard to get there, but it didn't happen overnight, right? We weren't posting everywhere all the time from the very
Right.
beginning. That would be too overwhelming and I'd probably just quit, right? So it's the same with anything. It's just about blocking and tackling, like you said, and just stacking little things on top of each other.
Yeah. This is cool. Well, we're kind of wrapping up, but I want to ask you one more thing. Who is somebody that inspires you?
Hmm. Well, I think there's some companies in our space that inspire me. Like MG Properties, for example, is a 30 plus year old company they look exactly like us. We're just, 25 years younger.
Yeah.
And so I aspire to be like them and just dialed in, buttoned up, conservative. That's definitely an inspiration to me. Aside from that, like kind of famous people, I'm not really sure. I'm not necessarily like a big Elon Musk fan, but I'm listening to his Joe Rogan podcast right now. And who else? I don't know. Yeah, I like to read and take advice from anywhere I can get it.
What is it about MG that inspires you?
So they've been in business now for 33 years, and they are pretty much doing the same thing they've been doing for 33 years, and that inspires me because I'm kind of boring in the same way. I just want to do the same thing for the next 30 years, and I just want to keep doing it better and better. I never want to lose investor money. I never want to make a capital call, and I just
Right.
want to keep things simple. I think people get over their skis or they get bored. They want to try new strategies, and that's when trouble can happen. So I just think I really like that they have 10 billion in assets under management, and I don't think they have any institutional partners. So they've grown their portfolio this whole ride with basically individual investors investing 100 to 100K to $1 million, I'll guess. And that's kind of
Mhm.
this similar vision that we have for ourselves because we really have found our niche in targeting sub-institutional checks of 5 million and below. So we work with individuals with a 50K minimum investment all the way up to, like you mentioned, family offices and boutique fund managers raising up
Yeah.
to 5 million.
Yeah. Yeah. I know you guys are across the board. You service quite a bit of people. I've referred some people to you, especially that are looking in that Texas market. I'm curious, you mentioned doing the same thing for 30 years and getting really good at it, like MG is an inspiration. What does that feel like? What do you want to build personally? Because a lot of people, and I know you particularly probably use real estate as a tool to, help build the life that you want. Like, what is it that you're trying to build?
Yeah, I want to build a business that runs really, really well. I want it to be exciting and challenging, but not stressful. And I think it's wishful thinking to say that business is not going to be stressful, right? It's going
Yeah.
to be stressful, but that's kind of the goal I aspire to. And I handle stress well, and it's not like I'm trying to like get a break here, but it's just it's a dream to just try to make everything 1% better, 1% better, and just build an amazing company, A players across the board, and we're just doing everything the best possible.
Yeah, that's super cool, man. Well, this has been a joy talking with you and doing a deep dive. If people want to learn about you, learn more about your company, where can they go?
They can go over to our website, lscre.com. On our website, we've got links to the books we've published and our fund manager underwriting toolkits. There's tons of resources to learn how to evaluate multifamily investments and a bunch of other good stuff.
Awesome, man. We'll make sure that that gets posted in the show links. It's been a pleasure having you on.
Thanks for having me.